They sold, not in chaos, not in panic, but with quiet precision. As the trading day was coming to a close, the S&P 500 slipped almost 1% from its highs. No breaking news alerts during market hours. No sudden scandal, but after the bell rang, the reason became clear. Moody's had just downgraded the U.S. credit outlook, and though it wasn't a full downgrade in rating, the change in tone said enough. It was like the market got a tap on the shoulder that whispered, hey, things aren't as stable as they seem. The United States, which has long been viewed as the most reliable borrower on Earth, is now under scrutiny. Moody's is pointing fingers at America's rising debt, and the message is simple. It's no longer just a long-term concern. It's now a real financial pressure point, and that pressure is showing. Government borrowing is soaring. Interest payments are climbing, and investors? They're getting nervous. You could feel that nervous energy ripple through the market. It wasn't panic, but it was a definite shift in tone. But what happened next was even more telling. Instead of continuing the sell-off the next morning, the market seemed to stabilize. Investors took a breath. Some even shrugged it off, believing the U.S. would still meet its debt obligations. But here's the twist. Just because America can pay its bills doesn't mean it can do it cheaply anymore. With rising interest rates, every new dollar borrowed costs more. That changes how governments operate. It also changes how investors think. Because if the U.S. has to keep paying more just to keep the lights on, what does that mean for everything else? Public spending, infrastructure, even social programs? And then there's gold. Whenever uncertainty rises, gold becomes the safe haven. In the hours after the Moody's news, gold prices ticked higher. People want security. They want assets that hold their value when the system feels shaky. But dig a little deeper, and you'll notice something important. Gold might be getting too hot. Analysts are watching how far it's stretching above its 200-day moving average, and the warning is clear. It might be due for a pullback. In plain terms, gold could correct soon, and that could catch late investors off guard if they jump in now without understanding the risk. As all of this unfolds, something quieter, but equally important, is happening overseas. Japan just released fresh economic data, and it's not great. Retail sales are down. GDP numbers came in weaker than expected. It might seem unrelated, but it's all connected. Japan is a major global player, and signs of weakness there reflect broader concerns about the global economy. If one of the world's most advanced economies is slowing down, and at the same time the U.S. is wrestling with growing debt and investor anxiety, it paints a bigger picture, one where uncertainty is no longer the exception. It's becoming the norm. So here we are. A downgrade that wasn't a downgrade but still shook the market. A stock drop that might just be the start of something deeper. A gold surge that may not be as safe as it seems. And global data quietly reminding us that economic strength is more fragile than ever. If you're an investor, this is your signal. Not to panic, but to pay attention. Because in markets like these, the smart money isn't chasing trends. It's watching the cracks form before the floor gives way. Thanks for watching the Money Blueprint. If you found value in this breakdown, drop a like. It really helps. And if you want more no-fluff finance content that breaks down the markets in plain English, hit that subscribe button. We've got plenty more to cover, and it's only just getting started.